Hello, good evening, good morning, wherever you're joining from. Thank you for joining in. Just to let me know if you're able to see me, hear me clearly, and I'm all excited to be a part of this session on small caps and, of course, anything about investing. So please do ask me any of your questions that you have, especially about small caps, but in investing in general. So we'll wait for a couple of minutes for people to join in, and maybe after a couple of minutes we'll start taking questions, and I'll be very happy to answer all of your questions. Thank you for joining in again. Okay, looks like we have a few set of people who have joined in. Thank you again for taking your valuable time to join today. I really appreciate you taking time, and I come here every Tuesday and sometimes on Wednesday. So today's session is about small caps, and I know it is a lot in the news, especially post SEBI coming in and sorry, once again. Sorry about these technical issues. If you can hear me clearly, please do give a thumbs up, a heart, a love, whatever you could. It'll be wonderful to see and believe that you're watching me, right? As I was saying, today's topic is about small caps. Small caps have gone through a very rough period in the recent days, especially after SEBI and SEBI's chairman have made few comments about small caps. Things like irrational exuberance, things like froth, things like overvaluations have become synonymous with small caps. It is not something that is new, to be very honest. If you go back to my live streams in December, if you go back to people, if you go back to my live shows or videos in the past, you would see that we have very clearly been pointing out that there is a bit of overvaluation in small caps. It is good to book profits or slowly move away from small cap. There's something that has been told time and again. So if you have any questions around small caps, it would be great. If you have any questions around investing, where to invest, where's the market headed, it'll be great if you could answer those questions. Sorry, ask me those questions, and I'll be very happy to answer. So there's an interesting question already. Uh, Priyanka, yes. Honestly, while we have the network, I think if you could write in a mail or a message saying, while we don't have a strong VC network connection, to be honest, you should try Mumbai Angels or you should try Hyderabad Angels. These two are great angel networks, in my opinion, where you may be able to crack some deals with few people. While I don't have any connections there, if I come across any, I would be happy to share your details or share their details with you. So if you could just send me a message on LinkedIn, or if you could just send me a mail on hello@mira.money. We will look into it, but I can clearly tell you that we are not very well connected with the pre-seed investors per se. Okay. Let me just I'll go a bit back and forth to see if there are any questions, so that so that I don't miss out on any questions. So open to questions. I have a few already ready with me. As always, there are a few questions that keep coming in from friends every now and then. But if you have any, I would be very happy to answer those. Right. So the first question or first view, this is not a question, but the view is Nifty small cap or BSE small cap was at about 46,400 beginning of the month, beginning of the year, which is calendar year. I think by mid of January, it touched 46,400 around that levels. And today it is at 42,832, which means roughly there has been a correction of close to 9%. Now, while we're all talking about corrections, sorry, there's a correction of close to 8%. While we are all talking about corrections, the question now you can also ask is it also a good time to invest now that there is a 10 or an 8% correction that has already been seen in few small cap stocks, or in few or many small cap sectors, or small cap in general itself? I think it's too early right now. In the past, I've started watching small cap closely since 2015. So it's less than 10 years. So it's not like I don't have a great data set yet to tell you that I know everything about small cap. But with a limited data set that we have generated in the last 9 odd years, what we have seen is that these kind of frothy valuations have happened in the past also. So between 2017 and 18, close to about 6 times, 6 months reflected this kind of a valuation, where the average returns after 1 year, the average was close to about 21%. But there are few months in which the returns after 1 year was as low as negative as 27% also. So it is definitely not a great zone to be in. It is definitely not something that you want to be investing at this or staying invested at this moment. So like what I've told earlier also, even today, I think if your allocation is beyond 15 to 20%, I think it is still a good time to reduce their allocation, primarily because small caps are looking extremely overvalued even after the 8% correction that we have seen since, for this year to date, as they call it, right? So be a little more wary and careful even today, provided you have more than 15 to 20% of your money in small caps, right? So no questions yet, surprisingly. Let me go back and check if there are any. Okay, no questions here yet. Okay, it looks like people have already heard enough about small caps that there are no questions, or I'm not sure. Okay, I can see now. See, this is the issue. I mean, there are these feed issues which I go through. I don't know why it doesn't really come through very easily. See, it's still not showing up. I don't know how to get those questions. Sorry about this. Just 1 second. I can see there are 5, 6 questions, but unfortunately not able to read any of them. Let me see. Okay. Good. Okay, now I can see few set of questions. So please keep it coming, guys. Shivam, we are already live. Vishnu, thank you. Yes, it is loud and clear. Wonderful. So first question is that I'm going to answer is from Vishrut Patel, whose question is, should I book profits in my small cap mutual fund or wait? Very good question. I think that is one of the questions that has been on people's mind already, especially after the recent corrections. In my opinion, I think even after the 8% correction that we have seen year to date, I still believe that there is a bit of negative return that is quite possible, even beyond this. right? The correction, in my opinion, has just started. So maybe it is still not a bad time to book out of small caps, and it is still okay to book profit. It is still okay to reduce your allocation if your allocation has gone beyond 15 to 20% or so. I am never going to tell you that go zero on small cap unless until you see some, I mean, absolutely crazy valuations. But at these levels, it is still okay to book some profits and get into better valued assets. And once the small cap correction is over, and if your allocation allows it, go big on small caps again, right? So I hope I answered that question, Vishrut. If you liked my answer, please do give me a thumbs up. Um, okay. Can we see this opportunity after some more correction? Which opportunity, Siva? If you could be a little more specific, it will help me to answer the questions. I still understand. I still didn't get your question saying, what opportunity are you talking about? Please do ask me, or make it a little more detailed for me to understand. Hi, Kamlesh. How do you see small cap news, and what's your view on upcoming days in small cap? Thank you. Um, there is whether there is a news or not. News acted as a trigger for small caps to correct. See, it was unjustified earlier also. Again, I'm going back to my December podcast, December live streams. We have told then also that there is valuations looks a little stretched, looks a little stretched. We have actually gone ahead and corrected small cap allocations for a few set of clients to the right levels, primarily because there was froth already available. There was already overvaluation in small caps. So this was obvious. And when SEBI came in, it acted as a catalyst or a trigger for people to pull that sell button or push that sell button. So this news, till the time there is decent amount of correction that you see, maybe another 5, 7, 10% or so, can continue to be broadcasted, will get repeated at many spaces till the time the same SEBI who's not comfortable with the valuation now believes that okay, the froth is over. Now the impact of any negative return, now the impact of any fall will not be too much on small investors like you and me, right? So SEBI is right now trying to protect the investors who have come in droves in the last 3-4 years and have invested for the first time. So they are trying to protect. So the day we see that SEBI says, okay, good, small cap news is now, they will stop reducing the small cap news and start increasing some other news. Till that time, you may see a bit more correction. Plus, it also warrants a correction. I'm not saying SEBI is manipulating. It is telling you the right valuation. I mean, I'm surprised. No, I have not seen any SEBI chairman coming and clearly, vocally telling about this. So I'm happy that someone is actually coming out and talking about valuations and overvaluations and frothy valuations, which is wonderful. I think small cap correction is here to stay for some more time, and maybe in the next 2, 3, 4 months, it could be so that the correction is stopped, and then you will start seeing some big opportunity also your way. I hope I answered that question, Kamlesh. If you liked what I answered, please do give a thumbs up. Okay. Let me see if Siva wrote another. I had another question. Sorry, Siva, I couldn't understand the question. Sorry about it. I'll go back and come. Okay. Now, one of the questions that I got on, I'll answer Siva's question first, and then I'll answer what is the question again. So Shiva, now small cap is corrected 8%. That's his question. Can we see this as a long-term investment opportunity or another 5 to 10%? Beautiful question. Looks like you are an opportunist. While I would have loved to say yes as an answer, I still think we have some more downside. I'm not saying I know how to predict the market. I know where the bottom is. I definitely don't know. But there is still froth, right? You are today ready to pay a certain price for investments that you're making. But even at the corrected levels of small cap, which is 42,000 or something like that of BSE small cap, I still think there is a little more downside to small caps. And by investing at these levels, you are still going to risk your capital. So if your allocation is not beyond 15-20%, I don't think, um, even after 8% correction, there is a need, or there's a big opportunity in small caps. Let's say if it corrects another 18%, oh, sorry, 10%, which makes it 18%, the whole investor community will start panicking, will say, never will I invest in small cap. You're going to get all these questions. You're going to hear a lot of people talking about negatively about small caps. The day you hear that is when be a little brave and go invest in small cap. We did that in February 2023. You could go back to Mira Money's app and see the history, or you can go back to our communications. You would see that we have done it. Similarly, you should use this as an opportunity, use that moment as an opportunity to invest. Today, I still think there is downside, so I may not really go big on small cap yet, because there is downside expected. I hope I answered that, Siva. Um, Great. Alex, how well are mutual funds positioned for redemption pressure on small cap funds in your view, especially since many retail investors are new to market and might be scared very quickly? I think this is an excellent question. I think this is the same thought that SEBI also has on its mind. There are a lot of new investors who have come, invested for the first time in the market, have never seen a fall in the market, because last 1.5 2 years have been like going up and up. Nobody has redeemed their money yet. Nobody has booked their profits yet, right? So SEBI sensed it, and I think that's the reason why they have called all the AMCs, all the mutual fund house, and asked them to do something called a stress test. Now, what is a stress test? Stress test is where, you test yourself, your fund. For example, I'm the fund manager of XYZ mutual fund, and I'm the fund manager of that XYZ mutual fund small cap. Okay. Stress test is where you are going to check if there are continuous redemptions. Can I sell my portfolio without impacting too much of the price of that particular company? So, for example, as a fund manager, I had invested, let's say, 5% in a company called ABC. Okay. When there is a redemption, I have to sell ABC. When I start selling 1, 2, 3%, will that impact the company so badly, that ABC so badly that ABC will get into a circuit, is what SEBI wants AMCs to come out with, do the test and say that, okay, if tomorrow there's a problem, I can liquidate my portfolio in 3 days, 100% of my portfolio 3 days, 90% of my portfolio in 2 days. Some number they have to come out with and very clearly mention out, so that as an investor, you're aware of the risks of investing in mutual funds, especially illiquid stocks or illiquid small caps, right? So that stress test, I've seen few AMCs actively doing it, which is very, very proactive. There are very good new age AMCs that have been doing it. So if they can, if everybody comes through, then you will also you can also use that as a parameter to choose your mutual funds. Today, honestly, I think few of them will fail stress test, because a lot of money is poured in. So that selling may trigger more selling, more price correction, which may trigger more selling. So that's how the cycle will. So I think the day people start panicking, till date they've not, but the day people start panicking, I think a lot of mutual funds will show pretty bad negative returns also. So I doubt stress test is going to be very good for a lot of AMCs. Few AMCs will come clean. I hope I answered that, Alex. Okay, I'll go back to LinkedIn to check if there are any questions. Okay, I could see some questions. Okay, great. Okay, now so there is the other question that has come through from other channels that I am there, in the sense of WhatsApp and things like that. My friends have asked is, so Anand, you asked me to book profits out. We did book profits. Our allocations are close to 10%, in some cases less than 10%, in some cases around 15% or so. What do we do with that redeemed money? Okay. By booking out profits, didn't I actually stop compounding my money? Which is a very fair question, because all these years we have been told again and again and again repeatedly that do not book profits, do not pay taxes on the book profits, because this in the longer run will affect your compounding. Very fair. But I think there needs to be a justification to book profits. If there's no justification and you're just booking profit because you've made money, is where the real problem is. Okay. If there is a proper justification saying I am booking out profits because I need the money, that's a different thing. I am booking out profits because the sector, the segment, the market cap that I'm investing is looking overvalued, and basis the parameters that I've chosen, that is still okay to do. Because, for example, let's take this example of small cap itself. Okay, from January 23 till January 24, you made about 50% return. This is an average mutual fund, mutual fund, all the small cap mutual funds, average return. There are a few outliers like 60, 62%, and there are a few below 50% also. So you made 50%. And then at the end of January, I come and tell you that, hey, you need to book out profits. You book profits, and then which was 50%, and you pay a tax of 10%, which means your total gain is 50% minus 10% tax, which is 5%, so 45%. You have made 45% net gain after paying for taxes. Okay. Now, if you didn't do anything, okay, the market has already corrected 8%. So your 50 has already become 42, let's say 43 or 44. So this is, while it's the taxation looks like it is justified even in a short window like 1.5 months. And let's assume that the sale of small cap continues. It falls another 10% or so. Your net gain after 1.5 years, or I mean, from now till next 1 year, which is 1 year and 2 years, right? From January 23 till January 25, you didn't do any exits. So your net gain was 38-40%. While in my case, I made in 1 year 45% post paying taxes, and I used my money smartly by getting into undervalued assets. So this is what I tell my friends. This is what I tell my investors. Compounding stops only when you don't invest your money back into something which is more protective. It doesn't stop when you book profits. It doesn't stop when you pay taxes on it. Of course, you should try and stop a lot of costs. Taxes are cost. You should try and postpone as much as possible. I am in for all that, but please use it a little more smartly and not just stick to the old concept saying, no, Mr. Warren Buffett said, with all due respect, I mean, I'm not saying I know better than him or anybody for that matter, but in my opinion, it is important that you do rebalancing at regular intervals so that you are not caught and your investing journey is better, smoother, right? That is my larger point, right? I'll stop here. I'll go back to questions and then I'll answer that other question that my friend asked. Okay, I'm just loading. Okay, the other question that my friend had was, what do I do with my the money that I've invested? This was a question that he asked me when he had started booking the profits, right? And fortunately, what I believe today is, again, this is Mira Money's team's belief, is large caps, even at these levels, look a lot better valued than mid and small caps. You may ask me, you may think, how can that be, right? Small caps are, at one end, you're saying small caps are overvalued. And on the other hand, you're saying large caps are rightly valued, and you're not even talking about mid caps, right? There is a reason for it. The kind of returns that mid and small caps have seen, honestly, if you actually go back and check, large caps haven't seen that kind of a return. Last year, I think they gave 24, 23, 25% returns or so, while during the same time, small cap generated 60, 50, 45% kind of a return, right? Yes, by nature, large cap is expected to generate lower return than mid cap, and mid cap is expected to generate lower return than small cap. That is fine, but the kind of difference in returns, right, between small and mid and large cap is so huge, right? That's the reason why we believe that. That's also one of the reasons why we believe large caps are better valued, better placed. Plus, it is also showing better growth than small and mid caps at this juncture. So, ideally, if you have booked out profits, right, we still believe there is value in investing with large cap companies or large cap funds. One of the segments that you can always look for is, Nifty. If you don't want to, break your head around saying, okay, which fund should I choose, which stock should I choose? Don't worry, just go and invest in a Nifty 50 ETF if you believe in DMAT and keeping your money in DMAT, or just go ahead and invest in an index fund also. That is something that you can always do at the moment. But if you are a little more, enthusiastic and you want to take a bit of call, not just the regular large cap call, then I think there are sectors which are looking pretty strong. In my opinion, today, very recently, I've spoken about that on my YouTube channel as well, which is Anand K. Rathi. What I've seen is in the recent days, what we have seen is banking especially offers a great value today. Banking, we believe, is at the cusp of taking off today. Why? There are three major reasons, in my opinion. First and the foremost is valuations. Everything belongs. I mean, at the end of the day, earnings. Fundamentally, everything is about earnings, and um, and on the other side, investing is about paying the right price for earnings. Right? Fundamentally, they say, right, returns are slaves of earnings, and returns are also based on the price that you pay for the earnings. So I believe, doing a simple research, if you just do a normal research, banking and financial services industry, which is close to about 33% of Nifty 50, right, is valued at 17 times its financial year 2024 earnings. Only 17 times. Do you know what is the valuation of Nifty 50 itself of FY24? It is 23. So you're saying a sector like banking and financial services is lowly valued than Nifty, which is a lot more generic itself. Right? This itself makes the valuations pretty attractive. I know that alone cannot be the reason to invest, but I'm just saying valuations are looking pretty attractive. The downsides are looking a lot lower than the upside. So the risks are better than rewards in the banking and financial services segment at the moment. Right. So that is what we strongly believe in. Second reason. So the second reason for us to believe bankings are looking good is, you see, both macroeconomic indicators, macro numbers, micro numbers, all pointing out about India's GDP growth. Now you can debate it whether it is exactly 8.4% or 7.8%. That's a different thing. But everywhere you see growth, and growth also means that corporates, MSMEs, retail stores, you and me, all are going to borrow. Corporates will borrow for growth, MSME will borrow for growth, retail will borrow for expansion or growth. You and I will borrow for, either for setting up a home, traveling abroad, doing our own expenses or doing things which we wanted always to do, and we are in a position to take the loans for it. So this clearly points out that we are going to be great customers and giving a lot of growth to banking and financial services, right? Because you're going to borrow. And when you borrow, banks will grow. I think, as per estimates again, banks should grow at about 16. Their loan book alone should grow at about 16 to 18%. Now, every rupee that you borrow will lead to more and more earnings. So the earnings per share of banks especially are looking pretty strong for the next couple of years at least. I never see beyond 3 4 years. It looks pretty solid at the moment. And the third reason why we believe banking and financial services are looking good is balance sheet. 2013 is when RBI came out very heavily on banks to say that please clear up your book. Tell me what is a real NPA. Don't try to hide it under the carpets. Tell me your real NPAs, whether it is 100 rupees, 1000 rupees, or 10,000 rupees. Post that, you saw a lot of mergers of PSUs happening. You also saw few private banks going bust and stuff like that. Today, the kind of banks that are left out with both private and most PSUs are looking good. They have a clean balance sheet. They can now go out and lend with a lot of rigor, with a lot of quality check in place, right? And when they have the might to do it, the loan growth will maybe, for all you know, can touch 20% also. I know it's a little big number, but I'm just saying. So all these three put together, valuations, loan growth, and clean books, make it very attractive for for us investors to invest in BFSI segment. I'm sure you want to know whether HDFC Bank is good. Unfortunately, I don't do stock analysis, primarily because my license is about fund distribution and not about stock analysis. So we recommend only funds. If you're positive on the sector that I spoke about, please go ahead and pick a good ETF, banking ETF, pick a good banking fund, active fund or a passive fund, and go ahead and invest in any of them, in my opinion. These are the three reasons. Of course, if you have any other reasons, please do let me know. But these are my three reasons for us to believe that BFSI is a segment to be in. Okay, let me see if there are any questions. Okay, no questions yet. Interesting. I'll go back and check if there are any questions. Just 1 second. Okay, there are no questions yet. Then I'll talk about where is the valuation. I've already spoken about you exiting and investing in maybe large caps, maybe BFSI as a segment. The other sector that we strongly believe looks good even at this point in time is auto. It is not as big an opportunity like banking, to be honest, but it's still, there looks like there is a lot more upside yet on on auto. So if you're an investor who believes who believes that, okay, let me take a little more risk on my 5% of my portfolio or 10% of my portfolio, then again, other than banking, auto looks good. Pharma is looking like it is looking up a little. I think IT now looks a little more topped out. Doesn't look like it can offer great value, because last year it didn't offer value because of growth it was offering. Last year it offered great value because of the price at which it was trading for the growth it was giving. I don't know if you got that clearly. Let me explain that part till the time somebody asks me a question. So there are two types of investing. One is where you pay price for growth, and then second is you pay price for value that it brings in. Okay. IT for a long period of time was growing at spectacular pace, correct? So when you grow at a spectacular pace, you're saying, okay, this guy is going to go faster and faster and faster. If tomorrow he demands 100 rupees, I will pay him 100 rupees. After a year, if he demands 200 rupees, I will go ahead and pay 200 rupees, right? So that's the kind of growth you're saying. So the price that you're paying is justified because every year he's growing higher and higher and higher. You saw it with Bajaj Finance, you saw it with Infosys, you saw it with TCS. They were just growing at breakneck speed. Then something interesting happened. Okay, when US recession in 2022, big news coming in, IT spending getting cut and all the stuff starting to come, the price crashed 30, 35, 40%. TCS from 4,000 went to 3,100 or something like that, right? So the price corrected by close to 25, 30% or so. Now, the growth is not going to happen. That's why they have fallen. But at a 30%, after a 30% fall, it inherently generates value. Primarily, I mean, even if it doesn't grow, for the growth it has already given, it has got value in the price itself. So ideally, it should be, what I'm trying to say is ideally that TCS shouldn't have been at 3,100. It should have been at 3,500. But because people bombarded it with selling, 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 and bad news, bad news, bad news, it went down to 3,100. Right? So this is called inherent value. These are my terms. And that other where you kept paying price higher and higher is called paying a price for growth. So last year, IT was a great inherent value pick. And years before that, about before 22, it was a pick for growth. Right? So in our opinion, we don't see growth in IT, and neither we see value at these prices. So we are trying to avoid IT now. We have exited out of it. We have got into banking at the moment. Yeah, so right now, banking, automobile, pharma are the sectors that we are pretty bullish on. Themes we are still figuring out. We ran a theme called consumption, looked good after COVID. Now we are still trying to figure out what is the next big theme. We have already run manufacturing theme. So any questions at the moment from people? I'll just go check. So I don't know if there's a feed issue, but I'm not able to see any questions. So I'm trying to see what is the issue here. Does anyone have a question? If you could just, I don't know if you're able to hear me also. If you could just say hi, or if somebody, I see that there are a few people who are listening. Could you give me a thumbs up if you're able to hear me? If you're liking it, if you want to have any, if you have any questions, happy to answer. Okay. I'm not sure if there's a feed issue. Any which ways, let me wait. Okay. Now, talking about investing, another segment and sector that we are pretty bullish on. Yeah, okay, thank you. I can finally see some fingers going up. Okay, so talking about investing. Okay, now I see a couple of questions. Okay, Akash, hi. How does infra as a segment look like considering the growth aspirations? Hi, Anil, I'll also answer that question. So infrastructure, it's a very large play. If you look at infra as a theme, it doesn't just include roads. It includes ports, it includes airports, it includes banks also. It includes raw material providers. Too many of them are involved in infra. So we have tried playing infra theme earlier, burnt our hands. I'm talking about 2008 and before. It did look good at that moment, but what we realize is it is not like a focused strategy at the when it comes to infra. So while everything looks great, I think that is one sector which I strongly believe one shouldn't do it via funds. That one theme, one should actually go ahead and invest in few stocks which are true blue infra companies. The funds that are there, that are available today with the mutual fund houses, don't have a true blue infra theme. Everybody, what's the point of investing into an infra which in turn goes ahead and invests in banks, right? Of course they will say banks are also lending, so they are also a part of infra, but I don't see that as a justification. So I think infra is a good play, little longer term in nature also. It may not go through heavy growth pangs like IT or pharma. So I strongly believe if you want to do infra, you should pick 2-3 stocks and go ahead and invest into those 2-3 stocks. It is definitely looking for longer term, Akash, right? What about HUL and Jha? So while I don't do stock portfolios at all, I'm very close to identifying if FMCG is looking like a value for money. Close to identifying. When I mean close to identifying, we don't do research on segments and sectors and themes every day. We do it only once in a month to figure out if all the noises have been reduced and things like that. I have always liked FMCG because it has shown a lot more trend, right? The good trends, in the sense when it goes up, it shows good trends, and when it comes down, it goes in a good trend. It's like unlike pharma. Pharma is a little more haphazard, while things like IT and banking and FMCG have shown beautiful trends. ITC and HUL, which are a part of FMCG as a sector, haven't yet shown anything strong enough for us to say that, okay, let me go ahead and invest into an FMCG mutual fund or an FMCG stock at the moment. While I don't do any stocks, I'm still waiting for the moment to go ahead and invest into FMCG. The day we believe in that sector and the day we start identifying funds, I think I will come back and definitely let you know. But at the moment, I don't see anything on the FMCG front to be a part of active sector portfolio. As a theme, as a sector, only see three sectors we are bullish on: banking, pharma, and auto. So I hope I answered that. Yeah. For some reason, again, I still can't see sectors. Okay. Any other questions from people who are listening? It will be great if you could ask me questions. Okay. Okay. Question from the other end, from my YouTube channel. Okay, so his question is wonderful. His question is, he has booked out some profits. What does he do with the money? I think you're a little late. I think you should go ahead and invest in rightly priced large cap funds, Nifty 50. You can go very big on that, because I think, I'll give you the reason for that. Okay, I'll again come back. So I'll give you the reasons why we believe on investing in Nifty 50 and large cap companies today. I will also answer that question about auto sector. I don't know your name, but I'll just answer that. Okay, so this is from one of the PMS service providers. They have shared this data. There are, let's say you take BSE 500 companies. Okay, the top 20 companies, or let's say about 20 companies, contribute about 50% of the earnings. About 50% of the earnings is concentrated with 20 companies, which is okay. It's an 80-20 Pareto principle and all this stuff. Now, what I see is, what they have shown is, because they have shown growth, instead of they have shown profit growth and things like that, instead of valuing them more, they've actually gone down on value. In the sense, if their contribution to the market cap was, let's say, 40%, so because they're contributing 50% of the return, they should actually go up to 42%, like in the US and all it has happened. In India, the reverse has happened. Instead of, forget being at 40%, they've come down to 38%, 33%. So these are called mega caps. So Nifty 50 is a mix of mega caps, right? For the kind of profit it's generating, it is not rightly valued at the moment. So I believe it's a great sector and segment to be investing in, right? So that is where your money ideally can go. Okay, Prateek, I think the two questions got mingled. I can sense private bank index is still undervalued. Absolutely, Prateek. Banks, I've already spoken a lot about. Banks are a good play for the next 18 months or so. Definitely. 3 reasons. You can go back to my channel, YouTube channel. You can see those 3 reasons. I have written it in detail. First reason is valuation, very attractive. It's only at 17 times valuation. Second reason is, if you actually see the loan growth, you and I are going to borrow. Ambani ji is going to borrow. A lot of people are going to borrow in droves. Birla is going to borrow. That will lead to good loan growth. And 3 is clean NPAs. So we are going to start on a great note. So I think banks will offer great value for investors. So other question is about auto. See, auto is not as greatly valued or rightly valued like Nifty 50, and not undervalued like banks. But we still think there is still a bit of room to go on the auto sector. Yes, we have seen good run in the last 1 year or so. I think the run may continue for another 3 6 months time frame, but the end is a lot more nearer for auto, because it will also get into an overvaluation zone at some point in time or the other, right? We need to believe that market goes in cycles. Today the auto cycle is somewhere near the top. I don't know where is the top, but somewhere around that level or so. So that the end to auto sector rally is nearer. So maybe you'll have to be a little more cautious when it comes to auto as a sector. Don't go overboard on that particular sector. The valuations are still okay, not a bad valuation. You can enter, but it is like you need to have a surgical attack kind of situation. Go in, make your returns, come out. Don't go in and stay there for lunch, dinner, or breakfast. No, it is not a good idea to do, especially for auto sector. You will still make returns, but maybe not a little longer story. It may be 6 months, 9 months story or so, right? I hope I answered that question. Okay, let me go back again to check if there are any other questions coming in. Hi. Oh yeah, okay. That was Sampanna. So hi. So Sampanna, I hope I answered that question. Prateek, do you have any follow-on questions for this Nifty 50? I think I've answered all the questions till now. I can see a few people watching. Please do ask your questions. I would love to answer your questions live, because it will help not just you, also for people who are going to watch this or watching this at the moment. Great. One good question from Prateek. NBFCs like Bajaj Finance, Bajaj Finserv, Muthoot Finance undervalued. With interest rate cuts in the next 2 years, these growth stocks can give a good rally. I am accumulating blue chip stocks which are growing at 20 to 30%, but stock price is flat in the last 3 years. Pradeep, if you have the mental strength to see companies doing well, but the stock not doing well, and testing your patience, I think then there is a good investor in you, right? You shouldn't. Yes, there are times where markets are actually there are most of the time markets are irrational. 20-30% profits we have seen 20-30% profit growth in few of the companies that you have mentioned. In spite of that, the price has not gone up, which is okay. It is always going to happen. But the day when market suddenly realizes that, okay, small cap is looking jittery, let me go and see better valued stocks, I think that is the day when you will see companies like what you have mentioned should start doing well. I am one of the investors I'm a one stock portfolio guy. So I have only one stock in my portfolio. So that should do well, I'm hoping. And I'm staying put with that company. Novartis, sorry, I don't do stock analysis, Gitanjali. So pharma looks okay. Not a bad price to get into pharma. There's a little bit more rally that looks, but I don't do stock analysis, and that requires an army of people, good deep research, which we honestly cannot provide at the moment. So unfortunately, I don't have the license also to talk about pharma. Sorry, talk about stocks. So sorry, I cannot give a view on Novartis, but pharma as a sector looks pretty good to us. One of the points that Prateek got in was about interest rates looking down. So can someone tell me, if interest rates goes down, I mean, how are you going to make equity kind of money if interest rate goes down? I have a suggestion to make there. But if someone knows one investment that you can make which will increase your debt portfolio returns by 3, 4, 5%, do you have that portfolio in you? Sorry, do you have that portfolio in your? Do you have that particular investment in your pocket? Okay, I don't. I mean, if you could answer that, I'll wait for it. Isn't having just one and okay? Yes, that's a good question. I'll answer that question about one stock portfolio. 1 second. Let me see who the person was who's asked the question, so they can address properly. Okay, I can't see him. Just 1 second. Okay, so sorry, I don't see the name in the feed. So Isn't one stock oh, absolutely, absolutely. Having one stock in a portfolio is very, very risky. um, it's like betting on something that may or may not do well. But um, it's an approach that you want to take after a lot of calculations. I'm a one stock portfolio, but I'm a diversified investor. Now you may think, how is that possible, right? Primarily because I have a few set of mutual funds which are much larger when I invested, which were much larger than the stock that I invested. So, for example, I am bullish on Mira Money, my company, right? I am bullish on my company, and let's assume that Mira Money is a listed firm. I go and buy Mira Money because I believe in the growth story of it, and I just invest about 10% of my money in that. Someone can say 5%, someone can say 10%, someone can say 1%. I went in aggressive and said, Mira Money looks very, very good as a listed company. Let me go and invest. I had invested, and fortunately, that particular company, which is in this case Mira Money, shot up significantly, making today it contributes, it's close to 50% of my portfolio, because that particular company that I invested tend to uh, ended up doing very well. Yes, it could have been the other way around, where it could have cracked and all this stuff. But I thought, having 5 6 companies, tracking them, managing reading their books, sorry, annual report, is going to be a little bit of a task for me, because I don't have the time to do it, while I have mutual fund already for diversified portfolio. So in the case of stocks, I took this approach after a lot of calculation. At that time it was 10%. Today it's 50-50, and I'm not worried about 50-50 today, because that stock is a mega cap today. So fortunately, it turned out okay. If you do your calculations well, you may also figure out the right strategy for you, but it requires a lot of mental strength. So just don't buy any small cap company which your friend says. Do your analysis and then do it. Right now, no, the Pratik, I still didn't get the answer which I had asked for. The question that I have is, if the interest rate goes down, okay, I am going to give you a portfolio which will give you which is a debt portfolio, government security portfolio, which will give you a return of 11, 12, 13% also. And I am here talking about 10-year, 11-year, 15-year GSEC bond fund. Yeah, long duration fund is we call them. I don't know if you have inequities. No, I think Pratik. So I'll tell you, right. So what I'm trying to say is, let's say it is already starting to show up in October last year. Let's say somewhere around let's just for calculation purpose, after June, okay, the 10-year GSEC went up to 7.4%. If you are invested into a long duration paper whose average maturity was 10 years, the return that you would have made in less than 6 months or around 6 months, what is the return? For 6 months, you would have made 3.5% of interest, 7.4, right? So 3.7% as interest itself. Okay. And because the yield from 7.4% today has come down to 7%, which is a 40 basis point fall. Yeah. In 6 months, your portfolio of 10-year GSEC fund roughly has given you 7% absolute return. 14% return is all you made by investing in a 10-year GSEC paper. I'm talking about zero credit risk. There are people going and investing in NBFCs, which are single A rated. People are doing PTP, P2P, and all that stuff. Very, very bad investments to make. Right? I'm telling you, I'm giving you a 10-year GSEC paper, which will give you which has given you a return, or which can give you more return than 7%. And there's no credit risk. Government is going to be there, right? There is no credit risk. I don't know why people are not latching up to it. They're going and giving it to banks which we don't even know, and risking their capital. Right? So this is called long duration paper. I have spoken about it. You can go to my YouTube channel. I've already spoken about it. Even in my app, we have created portfolios for this, right? You can actually have a look at it. Short-term bond will get advantage. Yeah. So net, this is the point I wanted to make. So debt, if you want to increase your debt returns, today is the day, because 10-year GSEC has already fallen below 7% yesterday. I think if the interest rate goes down, let's assume that it continues to go down another 0.5, 0.6, 0.7% to, let's say, 6.25%, your returns can be as high as 11 to 11.5% in a GSEC paper for a year. I don't think there is any other instrument, whether it is NBFC or anybody, can offer you this kind of a return on a government security, right? If you have any questions on that, please do ask me. I will be very happy to answer. And of course, small cap and these things will keep continuing. Any specific questions? Okay, so what is 9.5? Okay, short term. Okay, you're talking about equity. I'm talking about debt. That's the only major difference, Prateek. So, what we believe now going forward is, if you are going to invest, what could be the right allocation? In our opinion, even if you are a young 25-year-old investor, new to market, has a long time to go from here, or a 50-year-old person who has got 5-7 years to go to, have financial freedom, my thoughts are very clear. You should have an allocation of close to about 90% of your, if it is equity, close to 90% of your money in large caps, and about 10% of your money in maybe in some other assets also, especially equity. Micro cap index, yes. So Prateek, we are also looking at 2-3 options. We are going to call it as ultra aggressive portfolios, where you will see sector calls, where you will see theme calls, where you will be called satellite portfolios, where you will be also looking at gold as an asset, single stock single mutual fund portfolio, and micro cap also in that. But these will be called as ultra aggressive portfolio. The work is already on. We have already tested sector portfolio, which is 3 sectors and 1 factor indexes. We have already tested it for a year, worked beautifully. We will be launching that very soon in the next maybe couple of months, or less than a month or so, less than 2 months or so. So to complete on the allocation, and thank you, Prateek, for asking that question. To complete on the allocation, if it is debt, of course, you will have FDs and all this stuff. But if you have 2-year period, okay, try to invest your money in long duration fund. It is still active and looking good. It can give you double-digit returns, if not 11-12%, maybe at about 9.9-10% or so. It is still more attractive than NBFCs. And if you don't want to take all these calls, all you have to do is download the Mira Money app, and there are 3 baskets that you've already created. Smart debt for my long duration GSEC portfolio, and high growth for equity portfolio. We will take care of the investments. You just have to invest and relax. Any last questions, or I think it's already close to time for us. If there are any other questions, I'll be happy to answer. I'll just wait for one last question, or I think okay. Any last questions from any channel that we are on? Okay, by the way, I want to announce that next week I will try to do it in the morning, because there is a very important guest. It is Mire Assets CEO, who should be joining on 20th of March at about 11 a.m. Once I get the confirmation, I will post it here. So do spare your time. Ask him any questions that you have about Mire, about markets, about personal finance. It'll be wonderful. And the other big news is, as a lineup, we also are going to talk to PPFA's CEO and the founder's son, Mr. Neil Parekh, who's the son of Parag Parekh, on 12, right, on 26th at 7:30 p.m. That is confirmed. So we have great lineups of good CEOs coming in and talking to me about and wanting to answer your questions. So please do subscribe, join, follow me, so that you don't miss out on any updates that I give you. We are on, Mira Money is on every platform that you can think of. I am on every platform that you can think of. So you can just go subscribe. We keep giving live videos. We keep doing good explainer videos, shorts, and things like that. So it'll be wonderful to have you subscribe there. So 2 big CEOs coming in. Next week, I'll not be coming on Tuesday. I'll be coming on Wednesday, as far as the current calendar schedules go. If there's any change, I will let you know. If you like this, do give me a thumbs up. I would want to see how many people liked it. If you really found it useful, and if there are any questions, don't stop in. Keep asking me those questions in the comment section. I will try and answer all those questions. So did you like it? Do share it with your friends, folks, so that they can also benefit out of any live questions and any session that we do. Thank you so much. I can see a few thumbs up coming in. Any specific questions, please do ask me in the comment section, or write to us at hello@mira.money, or download my app and click the WhatsApp button, and you can ask the question on the WhatsApp. I'll be happy to connect. I still see 45 people, 50 people on the app. So if you have any, sorry, on the online, if you have any questions, I can spare some time also if you have any questions. Otherwise, it'll be good night. Okay, thank you. I can see a lot of emojis. Happy. I'm very happy today while the number of questions the quality of the questions were amazing. Though it was about small caps, I think, be a little wary. Okay, let me summarize it before I go. I think, I don't know how many questions can come in. Simple. Please make sure don't have more than 15% allocation in small caps. And even if you're a little scared, please make sure that you exit out of small caps if you're scared, right? And put the money to better use. Put the money in better valued Nifty 50 large cap companies, because they are a lot more better valued than this. When we can expect normal trades in the market? Nikhil, could you detail that question? I didn't get it. Nikhil, if you could just detail, ask that question again. Okay. I don't know if I got the question. Sorry, Nikhil, I couldn't get the question. If you could ask that question. Okay, I'll once you ask, I'll write to you. And thank you so much to all of you for joining in. Again, see you next week. It could be on Wednesday. It will definitely not going to be on a Tuesday. It's going to be on Wednesday. And the CEO of Mire Assets will join in on Wednesday. Thank you and good night.